Hello everyone, this is your Shivaji. Are you new to stock market? Looking for a simple methodology to find a stock valuation? Do you want to know whether a stock is overpriced or a hidden gem? Then PE ratio is one of the simplest calculation methodology to decode this mystery. In this video, we'll try to cover the logics in very simple way. Let's go to the video. PE ratio is basically a price to earnings ratio. The name itself says there are two data elements required to calculate the PE ratio. One is price and another one is earnings. Let's see one by one. The first one is price. Price is simply a stock price or the share price, right? What is stock price? We'll provide some simple example. Let's say a person A want to start a business worth of 2 crores and he is having 1.1 crore in hand as a cash or cash plus assets, whatever it may be. And he is looking for remaining 90 lakhs support for running this business and decided to list his company as a stock in stock market. He is coming up with a plan to list 9 lakh shares with each stock price as a 10 rupees to collect the remaining 90 lakhs from the market. He will start with 10 rupees as a base price, and this price will increase based on the demand from the investors, right? So the stock price is basically a last trading price of the stock, and that is what we are going to use as a first data element. The second data element is earnings. Earnings is considered as a earnings per share in PE calculation. Earnings per share is how a person A and his company is making profit for the 9 lakhs listed shares, right? Let's go to the formula for earnings per share. Earnings per share derived from net income of the company, which is actual profit made by a company minus dividend paid and divided by the average outstanding shares in the market. Dividend is something like giving profit back to the investors. A dividend is a portion of company profit that is distributed to his shareholders, usually in the form of cash. So all these details you can find in NSE website, and you need not to pay for any fee to anybody to get these basic details. Okay. Now let's go to the PE calculation. PE is equal to the first data element price divided by the second data element earnings per share. By looking at the formula itself, we can see that the profit related data element is in denominator. So whenever your PE ratio is low, that indicates the better price. Whenever the PE rate is high, that indicates the price is expensive for that particular company, right? Let's see this data element with some examples. Example one is Infosys company. Infosys Limited provides consulting, technology, outsourcing, and next generation digital services to enable clients to execute the strategies for their digital transformation. The share price is around 1489, and the earnings per share based on last 1 year data shows it's 65.6, and the PE ratio 1489 divided by 65.6, that gives you the PE ratio of 22.69. And the example 2 is REC Limited. REC is a central public sector company under the Ministry of Power, which involves financing the projects for the complete power sector. And the share price is 371. Earnings per share based on last 1 year is 64.1, and the PE ratio is 5.71. And the third company is Eternal Limited, which is earlier called as Zomato, one of the leading online food service platforms. Offers include food delivery, dining out services, loyalty programs, and others. The share price is 348, and the earnings per share is 0.33, which gives you the PE ratio of 1124. Based on the above three example, consider myself as a new investor entering into stock market. As of now, I have experience only in fixed deposit investment. Now I am moving into stock market, right? In that situation, I will always have a mindset of I don't want to take any bigger risk or high risk, right? With that mentality, now look at the table. The PE ratio of REC holds lower side, and Infosys holds medium PE, and Zomato PE is very high. Based on PE ratio, we can consider any stock with a PE ratio of 15 or less is considered as a undervalued. 16 to 25 is medium or average valued stock. And if anything is trading more than PE of 25, PE ratio of 25 is considered as a high valued stock. Now you will have a question. Then why high PE value stock is still keep on rising in the market? That is mainly because of two factors. One is the industry growth, and the second one is the company future growth rate or expectations from the investors. And before considering this PE ratio, right, one reverse math which you need to keep in your mind, like we saw one example, company A is listed, or a person A listed his company into the share market with 9 lakh shares, right? And let's say if he is having a PE ratio of 20, which indirectly tells you if that particular company is growing in that particular phase, then in next 20 years, the company is capable of buying back all the 9 lakh listed shares. That is what the indirect math, you can take it from the PE ratio. If the PE ratio is 20, then the next 20 years, the company can buy back the shares from the market, right? Similarly, lower PE ratio is not a kind of a direct indicator for buying the stock immediately. It's a kind of vice versa scenario, right? We need to look at, is there any problem with the company or challenges in making profit in future, or any regulatory risk or any pending cases or liabilities associated with the company is what we need to analyze, right? So we are taking the ratio based on the earnings, but if future is not good for that particular company, right, it is not advisable to invest. So based on the PE ratio, we need to still analyze the other factors as well. Example, here you can see expensive PE ratio greater than 25. Still, you can analyze the future growth of the company and the sector, and based on that, you can invest. Similarly, if any company PE ratio is medium, right, then you need to analyze the company's current performance and what is there for you in the near future. And if PE is low, then as I said, we need to analyze, is there any operational issues or any problems with that particular company before making an investment. Now, I hope it's clear on the PE calculation. Now, go back to the company examples and let's see the data again. Since I'm a new investor, I'm looking at the table and the PE ratio is low for REC Limited. Now I need to analyze the company future forecast or future plans, or is there any pending problems with a particular company, any challenges, those things I need to analyze. And the second share is Infosys. The price is medium based on the PE ratio. Now I need to check the company current performance and the future plan, and possibly I can fix some price band in the lower end stating based on my analysis on that particular company. If the price comes to this level, I can consider the PE ratio is little lower and I can go for it. That is how we need to approach a particular company which is having average PE ratio. Now come to the third company, Eternal. The PE ratio is very expensive, and still I need to analyze the sector wise growth opportunity and the company future plans and where they will land. Possibly I can assume some profit numbers for next 1 year, and I can do the same calculation of the PE ratio where they will land in the next 1 year, 2 year, 3 year, 4 year. That calculation I can make, and I need to go for the calculation, and I can decide whether to purchase this expensive stock at this point of time, right? I hope you have learned the simple methodology to find the stock valuation. Let's meet in the next video.